Imagine waking up on your 65th birthday. You open your retirement account. You stare at the number, and your stomach drops because there's a hole in it. A massive hole. Not 10 grand, not 50 grand, more like the price of a 3-bedroom house. Over $500,000 gone. And here's the worst part. You didn't lose it in a market crash. You didn't blow it on luxury cars. You didn't make one crazy mistake on a random Tuesday. You lost it slowly, quietly, almost invisibly, because of one decision you made decades ago. Or more accurately, one decision you never made at all. You stayed on autopilot. And that autopilot setting, it is keeping millions of hardworking people stuck in the rat race. Same paycheck, same hours, same stress, but completely different outcomes. One person retires anxious, the other retires free. So today, we're talking about the $500,000 mistake, the silent leak that drains wealth from the middle class, and the simple habits that can decide whether you spend your later years working because you want to, or working because you have to. And if you've ever thought, I make decent money, so why does it still feel like I'm falling behind? Stay with me, because this is not about making more money. It's about keeping more of what you already earn and putting it in the right place for long enough to change your life. Now let's get into the math, because feelings can lie, but the numbers tell the truth. Here's what most people do. They park their money. They put it in a savings account, or a random fund somebody recommended, or a retirement plan they set up years ago and never looked at again. They assume that because money is technically being saved, everything must be fine. But that assumption can cost you a fortune. So let's compare two people. Same starting point, same discipline, same time horizon. Person number one starts with $10,000, then invests $500 every month, every single month, for 30 years. This part is important. This is not about being perfect. This is about being consistent. Now, path A. This person plays it safe, or maybe they take advice from a friend, a coworker, or some so-called expert without really understanding where their money is going. They earn an average annual return of 7%. After 30 years, they end up with about $682,000. And at first that sounds pretty good. Most people would hear that number and say, wow, I'd take that. But wait. Now look at path B. Same $10,000 to start. Same $500 a month. Same 30 years. The only difference is understanding. This person takes time to learn what they own. They avoid unnecessary fees. They stop chasing hype. They stop confusing activity with progress. And instead of settling for 7%, they simply match the historical long-term average of the S&P 500, around 10%. After the same 30 years, they end up with over $1,260,000. Let that sink in. Same income, same monthly contribution, same amount of discipline. But one person finishes with roughly $578,000 more. That is the price of not knowing what you're invested in. $578,000. Not because you were lazy, not because you were stupid, because no one taught you that a small gap in return compounds into a massive gap in life. And this is where people get fooled. 3% sounds tiny, almost harmless. In normal conversation, 3% feels like background noise. But in investing, 3% over 30 years is not small. It is the difference between I think I can retire and I know I'm set. It is the difference between hoping your money lasts and knowing your money works harder than you do. That's the real lesson. Over time, your wealth is not built mostly by what you put in. It is built by what your money earns, and what that growth keeps earning, again and again and again. That is compounding. And if your money is growing in the wrong place, too slowly, with too many fees, or with no strategy at all, you are not just losing returns, you are losing years of freedom. So if the math is this obvious, why don't more people choose the better path? Simple. Because we get distracted, we get emotional, and we fall into one of the biggest traps in personal finance: active trading. This is where people start thinking they can outsmart the market. They see a headline. They hear about the next hot stock. They watch the news scream about a crash. And suddenly, investing turns into a guessing game. Buy now, sell now, wait for the dip, jump on the rally, panic at the bottom, celebrate at the top, repeat. And it feels productive. That's the trap. Because activity feels like control. But in reality, for most everyday investors, it creates worse results. Even professionals struggle to beat the market consistently over long periods. That's with teams, research departments, algorithms, data, experience, and even they miss. So what makes the average stressed-out person think they're going to win that game while checking their phone between meetings, or listening to a cousin with bad credit talk about a can't-miss opportunity? That's not a strategy. That's a casino with better branding. And once you add fees, taxes, bad timing, and your own emotions, active trading becomes one of the fastest ways to sabotage your future while feeling smart in the moment. Here's the truth most people need to hear. You do not need to beat the market. You need to stop losing to your own behavior. That's it.
If you can stop trying to be clever and simply match the market through something like a low-cost S&P 500 index fund, you will likely outperform the vast majority of people who are constantly jumping in and out. Read that again. The goal is not to look impressive. The goal is to become wealthy, quietly, predictably, over time. Because if you don't understand the pros and cons of where your money is sitting, you are not investing. You are hoping. And hope is not a financial plan. But even if you fix your investments, there are still 2 more leaks that can keep you stuck. And these ones are sneaky because they don't always feel like mistakes. The first one is taxes. For most Americans, taxes are the biggest expense they will ever pay. Bigger than vacations, bigger than car payments, sometimes even bigger than housing. But the wealthy don't just complain about taxes. They plan around them. They use the rules. They use the tools. They use accounts designed to legally protect more of their money. Things like IRAs, Roth IRAs, and 401ks. These are not boring little side accounts. These are wealth-building machines when used correctly. Because every dollar you shelter from unnecessary taxes is a dollar that can stay invested, keep compounding, and keep working for you, year after year. So if you're not maximizing those accounts, or at least understanding how they work, you may be giving away a huge chunk of your long-term growth for no good reason. And most people never notice it because the leak is quiet. Now here comes the second trap. And this one hits even harder. The I deserve it trap. You know the voice. I work hard. I've had a rough week. I should treat myself. And listen, sometimes you should. This is not about never enjoying your life. This is about understanding the true cost of turning every stressful season into a spending decision. Because that new car, it doesn't just cost the monthly payment, it costs the investing opportunity you gave up. That luxury vacation, it doesn't just cost what went on the card, it costs what that money could have become in 10, 20, or 30 years. And this is where it gets uncomfortable. A lot of people call things rewards that actually keep them trapped. If your reward creates more pressure, more bills, more financial anxiety, is it really a reward, or is it just expensive relief?
Real reward is not looking rich for a weekend. Real reward is peace. Real reward is margin. Real reward is knowing one emergency will not knock your life off course. And that brings us to the deepest part of this whole conversation. Because the biggest trap is not a bad fund, or bad tax planning, or a bad purchase. The biggest trap is a bad mindset. I hear people say this all the time. I don't care about money. But let's be honest, that sounds noble until you really think about it. Because those same people spend 40, 50, sometimes 60 hours a week working for money. Money decides where you live, what you eat, how much stress you carry, how much time you own, what kind of health care you can afford, what your kids experience, when you can stop working. So no, caring about money is not greedy. Caring about money is caring about options. Caring about money is caring about freedom. And the most dangerous sentence in personal finance is this: none of this will work for me. Because that sentence shuts the door before you even touch the handle. It lets you avoid change. It lets you avoid responsibility. It lets you stay on autopilot and call it realism. Maybe your next move is downsizing. Maybe it's moving to a more affordable area. Maybe it's getting a roommate for a year. Maybe it's finally leaving a career path that looks stable on paper but is taking you nowhere. Will that be easy? No. Will it be comfortable? Probably not. But neither is being broke for the next 20 years. That's the trade people ignore. They say they want a different future, but they refuse a different process. And yes, building wealth is easier for some people than others. That's real. But harder does not mean impossible. There are always options. There is always a next move. There is always a smarter decision than autopilot. So here's the wake-up call. You do not need a miracle. You do not need perfect timing. You do not need to suddenly become a finance genius overnight. You just need to stop leaking money through the same traps year after year without noticing. Check your investments today, not next month, today. Do you know what you own? Do you know what fees you're paying? Do you know your average return? Do you know whether your money is actually aligned with your future? Are you using your tax-advantaged accounts the right way? Or are you just assuming everything is fine because no one told you otherwise? Do not let a $500,000 mistake become your life story. Do not wait until retirement to realize you are working hard but moving in circles. Wake up now. Make the adjustment now. Build the habits now. Because the people who retire with freedom are not always the ones who earned the most. Very often, they are the ones who understood the game soon enough to stop making invisible mistakes. If this video helped you think differently about money, hit the like button and subscribe. And if you're serious about taking control of your financial future, stay with this channel. Because we're going to keep making personal finance simple, practical, and real. I'm Mikey Finance, and I'll see you in the next video.